girls, welcome back to another BMO educational video. Today we're going to be looking at leading versus lagging indicators. You may have heard these terms before, but especially now in 2023 or late 2023 when I'm recording, it's definitely a thing for you to really look into now, especially the leading indicators, which we'll get into in just a moment. And it's quite an easy thing to understand, of course. It's relatively easy, but you know, there's a fair amount of work for you to do going forward. Nobody said it's going to be easy, of course. Now, first, let's have a little look at just the definitions, and then we'll move on from there. So, of course, we have leading indicators and lagging indicators. Firstly, what is a leading indicator? They're also known as forward-looking indicators. So you may have heard like institutional traders or analysts on like Bloomberg TV or the docs you read, or even the websites you look at. They may class it as forward-looking indicators, but both it's just a different meaning. They typically tell you what the future could be. So the data prints out, and the markets will look at that data and think, okay, you know, this may suggest this for this bit of data going forward. You can make a forecast or decision based on these factors. So like I mentioned, if for example, data comes out and you look at it and then you say, okay, inflation may have to tick up slightly. And then from there, you might think, well, the logical way of thinking after that is if inflation ticks up higher based on the leading indicators or the forward-looking indicators. Indicators we're not talking about like lines, we're talking about data here. If this data in the underlying leading indicator points up, that means inflation points up. Maybe the Fed or the ECB or whatever central bank you're looking at may have to be a bit more hawkish going forward. That might drive the currency higher if the other data supports it. Then they can have conflicting factors, and some data may not be as reliable as others in a specific economic cycle. What we mean by that is, notice how, think about the reaction function video. If the markets don't react too much to data, to specific points of data, that either tells you, one, it's been priced in already. If it's like a main bit of data like inflation, we don't see much movement. Doesn't mean that it's not important. May mean that either one is already been priced in, or two, the markets don't really care about it. So if it prints lower than consensus, the market doesn't react to it, or even if it prints higher than consensus and the market doesn't react to it, that tells you that they don't really care about that specific point of data. And this is why you have to consider always what is the theme of the market, because that tells you what data you want to be looking at going forward. So like I said, there are conflicting data whereby you might have some leading indicators suggest that some the bits of data, or like let's say inflationary data or going forward, or GDP is going to come out stronger, but then you might have other bits of the leading indicator data, forward-looking indicator, shall we say, comes in, let's say, weaker. That doesn't mean you're not going to trade, or now that you're going to move more towards one end. You have to consider what is the theme, and if the data that has come out weaker doesn't fit in with that theme, i.e. it's a data that doesn't really affect that theme, then the markets won't react to it, and now you just kind of push it to the side, and just always consider what the markets are all talking about. So what is a lagging indicator? This data tells you what has already happened and doesn't predict what could happen. So that's really, really important. Lagging just confirms a trend, remember. It just tells you how has the conditions of that month, quarter, or year been. So obviously this is when some of the data you look at is quarter on quarter or year over year. It just tells you what has it been at that period. So during that quarter, it's been this. So it just confirms it. It doesn't tell you. It doesn't have bits of data within it that would suggest, maybe employment's going to come in weaker going forward, or maybe there's going to be a bit of a supply issue going forward, for example. It doesn't tell you that. It just confirms it. Then it can confirm if policy decisions have been correct so far. What we mean by that is, for example, if the Fed, or let's say, if the Fed expects to, let's say the markets expect the Fed to go a couple more times in their hikes. Obviously, I'm recording this on October 23. The markets don't expect another hike yet until obviously more data confirms it. But let's say they do, and the markets see actually, yeah, Fed, you need to hike by 2 to 3 more times based on inflation still really hot, labor market still really tight, etc. Then we start to see that the lagging indicators comes in weaker. Do you think at that stage then the markets would say, we're still very, very strong? Because remember, the lagging indicators tells you what has already happened. If the markets are now starting to see that, the trend is now pointing lower based on the lagging indicator, that kind of tells you that maybe, just maybe, the Fed or whatever central bank you're looking at may not need to hike again, or they may need to cut earlier, of course, on the other end of the spectrum. Now, think of yourself as driving a car. Remember, I'll give this analogy. I heard this, I can't remember I heard it, but this is a pretty good analogy. You're driving a car. Obviously, I think this is an A1, maybe A1, A3, Audi. Driving a car, and I've kind of given you a clue here. Which do you think is a leading, and which do you think is a lagging? So where I pointed the arrows, so obviously over here and over here, what do you think this one here is? So is this going to be leading, or is this going to be a lagging indicator or forward looking? So firstly, obviously this one over here is leading. So think of leading indicators like driving, and you're looking through the windscreen. So you're seeing where you're going. Remember, leading indicators tell you where you could be in the future. Lagging indicators is like looking in the rearview mirror, and all it does is just confirm where you have come from. So in a way, leading indicators do drive where the lagging indicators go, right? Because if you're driving, you're going forward, eventually where you've driven, eventually as you're driving forward, you're going to look through the rearview mirror as you're in this tunnel, and you're going to see where you've just come from. So in a way, leading indicators drives or gives us a clue what the lagging indicators are going to be. So that's something just to note here. But this is a really good analogy that I heard, and it's kind of stuck with me. Leading, think of it as you're driving a car looking through a windscreen. Lagging, you're driving a car and you're looking in the rearview mirror, and that tells you where you've come from, of course. Notice how when you're driving, you're not looking through a rearview mirror and you're saying, this is where I'm going to. It's where I'm coming from, or where I've came from. So here are some examples of what leading indicators are. So I'm sure you can kind of guess already. But first we have like retail sales. So in a way, retail sales, you could suggest, this is a leading indicator because retail sales comes in stronger. There are some elements within that might suggest inflation might come in slightly hotter to some degree. I have seen some arguments for it being a lagging indicator as well, because it does tell you where we've come from in terms of the spending. So it kind of top and tails between them both, but they do work with each other in terms of leading and lagging. Consumer confidence as well. I have seen people talk about how consumer confidence can also be a lagging indicator, because consumer confidence, one, it does tell you what the spending habits could be in the future, because if people are confident, they are more likely to spend, and that might lead more to better retail sales and better lagging data in the future, and may also impact sort of what the view of, let's say, inflation is like. So, but I have seen the argument, which I do also agree with, how it could also be a lagging indicator, whereby consumer confidence just confirms for that month how the consumer has felt to some degree. So I do agree with both arguments here. The main one that everyone is talking about is PMIs at the moment. So as we know, PMI data has that underlying data that tells us how inflation's been, how is the supply chain been, how is the employment sector been, and that all gives us clues as to what could the future be like. For example, we know in the UK, we saw that PMI data drop into contraction territory, so obviously below 50. That gave the market a view that the largest component of the UK economy is now contracting, and therefore the data going forward, the lagging indicators, are going to print lower, and that's going to impact, the market's obviously going to price this in before they see the lagging indicator, of course, but now the thought process is going to be PMIs comes in weaker into contraction territory. This is going to impact employment in the future. This is going to impact inflation as well. And therefore, the Bank of England is going to be a lot more dovish going forward. Why am I going to be buying the pound? Durable goods orders, of course. Job openings and hiring. Of course, that impacts the views on spending and inflation. Initial jobless claims. These are just some examples. There are, of course, more. Building permits. and of course bond yield. So there are more to this. I'm not going to put all of them because I'll have to go through quite a lot. But these are just some examples of leading indicators. Again, for example, building permits. UK data or on trade and economics, they don't put building permits on there. Maybe the bank or maybe the ONS doesn't, or the ONS would print out building permits, but they don't. Based on trade and economics anyway, they don't have building permits, but they may have something else that is basically building permits. So this is why these are just some examples, mainly the US, of course. But all you think really is, does this data tell me what could happen in the future, or does it just confirm what has happened already? That's kind of what you do looking at each bit of data, because Australian data might be slightly different to US's data. So just think, does this data tell me what could happen in the future, or does it just confirm what's already happened? So obviously, examples of lagging indicators, I'm sure some of you may already notice, like unemployment rate, that doesn't tell us anything within that about how inflation is going to be in the future. It just confirms that for that month, people have become unemployed. It doesn't tell us, though, what could be the future down the line. GDP, of course. GDP just confirms what's already happened. It doesn't give us any clues as to what could be down the line, because within all this bits of data over here, retail sales, consumer confidence, PMI data, that all tells us, one, how the consumer's feeling, how they're spending, what's their spending habits. Within PMIs, there's of course a backlog of orders, which in a way is a supply chain issue. If you're starting to see supply chain issues, then that obviously drives inflation higher. So that gives us a forward-looking view on that, of course. Job openings, initial jobless claims, durable goods, so that all just tells you how the consumers are. Bond yields, of course, naturally, if bond yields are rising, that gives us a view that maybe the markets expect inflation to rise and interest rates to rise, for example, or mainly interest rates in this example. But GDP, it doesn't tell us what could be the future. It just confirms during that period, during the quarter on quarter or the year over year, this has already happened. But like I mentioned, the leading indicators just give us a clue as to what may happen to the lagging indicators going forward. Inflation rate. Well, inflation rate doesn't really have any bits of data, or it doesn't tell us what could be. It just confirms that for this period here, there's been this much services inflation, or there's been this much housing inflation, or oil price or energy prices have contributed this much to inflation. You would have already known that if you saw oil prices rallying really aggressively. So it doesn't tell us what could happen, just confirms it. Of course, interest rates, naturally. That's self-explanatory. House prices, well, there are no linkage between higher housing prices and what could happen down the line, because that always to do with how high are rates going, how's inflation, how's the consumers. Everything adds into how the housing prices are, demand for it, etc. Debt data, naturally, of course, it doesn't really tell us what could be down the line in terms of debt. And trade data, so what we're talking about here is like trade balances, etc. That doesn't really give us clues as to what could be the habits down the line, just confirms it. So if you saw, for example, supply chain issues in that, maybe you'd think, this is going to impact the trade data, or this is going to impact our import market, for example. So therefore, you could gauge from understanding the supply chain issues within, let's say, manufacturing PMIs that could impact, in a way, the trade data. So that's something to mention. So leading indicators and lagging indicators, pretty self-explanatory. They're relatively easy to understand. Leading, just think of this analogy that we're speaking about here. Think of it as driving your car, looking for a windscreen. So you're driving, you're seeing where you're going. Lagging is just confirming where you've come from, not where you're going. So that's the best analogy I heard. So now that we've given some examples, like I mentioned, there are others out there for specifics, but you can kind of see where I'm heading toward in like job openings and hirings, purchase PMI data, consumer confidence, retail sales, initial jobless claims. This all tells us the habits of what could be down the line. Now, just an honorable mention, coincident indicator. So what is a coincident indicator? Coincident indicator gives a view of what the economy is like in real time. Like right now, how is the economy? That's a coincident indicator. Now, it can be used in conjunction with leading and lagging indicators. So the main ones you really want to be focusing on going forward is leading and lagging, but also just have this in the back of your mind, just a coincident indicator. So some examples may include GDP. So you might be thinking, this is a lagging indicator. It can be both, and let me explain. So a GDP can be a coincident indicator because one, it month-over-month GDP data tells you what's happened just last month. Quarter-on-quarter, year-over-year, obviously it's told us what's happened many, many months before. So it really depends on when it's printed. If a quarter-on-quarter data prints it the day after into the new quarter, that in a way would be classed as a coincidence because it tells you exactly very close to when it's already happened. If GDP quarter-on-quarter, let's say in the UK for Q3 comes in December, well, that's obviously a lagging because we've gone through the months already within Q4 to confirm what's already happened in Q3. We have personal income. So obviously personal income would be a coincident indicator because it kind of tells you what has people earned within that month period. Business sales, of course. These are just some examples of coincident indicators, but the main ones you really want to be focusing on are these ones over here. Leading and lagging. These are the ones you hear more about. But just have coincident on the back of your mind. Just think about it as, in terms of when the data has printed, does this confirm what's happened a few months ago, or does this confirm literally what has just happened? Now, here's a little triangle. I don't think it's, I'm not too great with drawing, of course, but at the top of the pyramid is going to be leading indicators. I have put at the bottom right coincident indicators, and I have put an arrow on either side just because they work hand in hand with each other. So leading indicators are also in a way coincident indicators. Coincident indicators can also be a leading indicator, for example. So they work hand in hand. Where do you think this all points to? Over here. All points to what? A lagging indicator. Then the lagging indicator obviously then goes up to leading. The leading then in a way drives what the lagging is doing. So that's something just to note there going forward. Now, what are leading indicators? Remember, leading indicators gives you an idea about how the economy may be in the future. Markets will use this information to understand if policy may need to be tightened or loosened. So, like we mentioned, if retail sales are coming in hotter, if consumer confidence is climbing, if we're starting to see stronger PMI data, if we're seeing, in the US's example, good durable goods orders, and we're seeing building permits climb and initial jobless claims being pretty good, this gives us that maybe inflation is going to be slightly higher. The labour market's really tight. Maybe the Fed may need to go again. So it gives you a view of what could be the future. Remember, and the markets will trade that. Remember, they'll trade something new. For example, if the services PMI data starts to go into contraction territories, this means that the largest component of the developed world portion, what I mean by that is most of G10 or all of G10 is mostly services based. You are going to have specific, let's say, emerging market countries who rely a bit more on manufacturing. Of course, China rely a lot on manufacturing. So you do have to be a bit more evident or a bit more urgency on the services PMIs when you're looking at the pounds, the dollars, the euros, the AEDs, the CADs. Yes, some of them may export commodities. That's why the percentage will be a bit less, let's say 60% services, whereas the UK is 75% services. So there are going to be a bit more in terms of percentage, but just think the most of the developed world are mostly services based. Markets will then use this information to decide that the central bank will need to pause and data such as inflation, retail sales, etc. may fall in the future. That's something just to note there. So naturally, because, leading indicators can also lead other leading indicators, right? So if retail sales are starting to fall, well, that might be indicative of less consumer demand. So if less consumer demand is falling, maybe consumer confidence might fall again, for example. Maybe if employment sector within the PMI data falls, maybe that might lead to, let's say, lower bond yields because now there's less consumers or there's less employment within the PMI data. There's also less inflation as well, let's say, within the PMI data. That would lead to lower bond yields naturally because, well, yields will fall if this impacts what the Fed or what the ECB or whatever central bank is going to do in the future. And that will lead to less rate hikes and maybe cuts in the future. So you can kind of say they all work hand in hand, but the main sort of viewpoint you need to have is leading kind of leads in a way what the lagging is going to do. Think about that analogy of driving a car. Important to note is that certain data will not be at focus. Example, housing starts had a huge upside move for the UK in July, but other data since then has pointed lower, like PMI data. And how do you understand? Remember, always focus on something. How do you understand what the markets are focused on? Remember, the theme of the market. What does the market react more to? This is the theme. What does everyone talk about? When you're reading documents, when you're understanding what everyone's really focused on. For example, we know at the moment markets are really focused on growth data because that impacts how many more hikes the Fed may have to do, or if cuts are going to come earlier. So you now know in the future, any employment data is going to be massively volatile and markets will react to it, basically. This is really, really key here. And think, what is the theme of the market at the moment, and what's it likely to be in the future? Think which data supports the theme. This is really important. So as a trader, you obviously think, one, what's the theme of the market at the moment? For example, we know at the moment the theme of the market is growth data because, well, growth data is going to impact how early cuts are going to be. Now that let's say we're next year, okay, cutting, this is happening. Okay, what is the next thing likely to be? This is what you think about. How, for example, in 2022, and of course early this year, was talking about the theme may likely be the growth data, because naturally, as you're raising rates, something comes at the cost of it. So it's growth. So naturally, the markets were hiking, stronger. And then growth started to fall naturally. And let's say in Europe is a good example of that, where rates have risen so fast, growth has started to really be affected. Now the markets are really evident where they moved away from inflationary data more towards growth data, because that also impacts inflation, remember. Think about that leading indicator data, like for example, let me just move this over here, job openings and hiring, employment, initial jobless claims, how many people are claiming for jobless benefits. This all impacts what? The unemployment rate. It will impact also GDP. It will also impact inflation, which will then impact interest rates. So you can kind of see how this gives an indicator, potentially, remember, potentially. This is really important. It's not a 100% correlation. It gives you a potential view of what could be the line, what could be down the line for that specific economy, and as a result, the currency. So in a way, you need most of these to kind of work hand in hand with each other to give a view of what these are going to be. Now, what are lagging indicators? Naturally, of course, you understand. Lagging indicators just confirm how the economy is performed and doesn't suggest or do not suggest what could be waiting for us down the line. Very, very important. Use lagging indicators to see has policy decisions been correct. Remember, if, for example, GDP comes in weak for the US, it's expected to come stronger. Markets will then use that as an almost 100% probability now that the Fed will not hike again, because this confirms trends, right? Lagging indicators confirms trends. Leading or forward-looking indicators potentially tells you what the lagging or what could be down the line. So if this is just confirming that, yes, the US is now slowing a lot or not growing as quickly as we initially thought, the markets will think, this is quite a big thing here. And that may impact what the Fed is going to be. But obviously, this is what I just mentioned. If GDP prints lower than consensus, but the central bank has already hiked and is expected to hike further, this may conflict with that view, and the currency may likely weaken further. That's just something to note there. But of course, you'd also have to look at then the leading indicators and think, are they still pointing up? And then you'd obviously have to figure out as a trader, does this mean you're now bearish, or does this mean you might be slightly neutral or moderately bullish, for example, or full out bullish? Of course, it all depends on how the data has been. Use lagging indicators to confirm economic trends. Leading indicators suggest the trends. That's quite a good one. Remember the analogy of that driving the car. So that's it for today's video. Quite simple. But what you should be doing now in the future is going toward these over here and thinking, okay, how's the leading indicators for the UK? How's retail sales? How's consumer confidence? How is PMIs? You are going to have conflicting data. For example, you might have consumer confidence in the UK pointing up, but PMIs are pointing down. This is when you tail back to that as what's the theme at the moment and what's the market reacting more to. And that gives us a clue as to what the markets will be focused on. Then you'd also think, okay, markets are reacting more to PMI data at the moment, which they are. That's going to impact what inflation is likely to be. And as a result, impact what interest rates are likely to be. May also impact, in a way, what GDP might be. Because, of course, GDP has a lot of the PMI data has a lot of the employment sector. And that might impact this bit of data over here. And this, it all goes within it. But please, obviously, Drew's made a video on that about GDP and the components of GDP. So please watch that if you haven't already. That's it for today's video. If you have any questions, please send me a message. Take care.